automatically gets registered for tax as well. Now, you'll find the company having I think the articles of association stating that it's not restricted to any type of business. It can trade in anything that it wants to trade in as long as it is legal. Now,
Yes. All right.
Continue, for example, you'll find a company having a property business, maybe transport business, cleaning business, security business, under one tax number.
Yes.
So if it incurs a loss in the security business, does it mean it cannot set off that assessed loss against the other income streams?
It will be, for an example, when you register a company, you need to state the nature of your business, isn't it? Either specifically concentrate or focus on mining or construction or butchering. But if you are saying that this involves in other activities, meaning that it can be a butcher and a bakery in the same business, you can operate those things, but you need to identify SARS, because again it will enable SARS to see what kind of expenditure that this business can claim. Remember, for SARS to know which expenditure, they need to look at the nature of your business, isn't it? So that they can be able to know what kind of expenditure you can claim as a business. So if in your registration, in your memorandum of articles, you need to state if it is solely construction or a mixture of business. Then if it is a mixture of business, that it makes sense, Tando. You can claim those assets losses, because it's what you have said to start that, no, my business is not concentrating on only on mining, only on construction. It does all things.
So in short, if you make a loss in one income stream, I mean, you can set it off against the other income stream.
Definitely, absolutely, you can do that. Remember, it's only be directed, but what you have said when you register the company. Because when you register the company, you said it's mixed business. It's not like you are the issue will be if you are saying it's a mining business company. When you register, then now all of a sudden there's a construction company loss, then you cannot offset the two. You can't.
Okay.
But if you state, that's why if look at the supermarkets, they are selling everything. It can be clothes, it can be food. So that's why the nature of the business is mixed, because they can do everything within same business, and they can be able to claim any assessed losses, because their memorandum of articles, or when they register, they've specifically said they are concentrating on a mix of business, not only concentrating on a butchery. Because, for example, let's say you are saying you are a butchery business, then what am I going to look as expenditure? Expenditure that relating to that butchery business. I cannot find any bakery expenditures under a butchery. Can you see? You can't do that. But as long as you said it's a mixed business, then meaning that you can do all these things, then it's okay. You can be able, assess losses, yes, can be offset against any income that will be derived in that business. But if you are so specific to say, no, it's a butchery, then when I see the expenses of bakeries, then I'm going to disallow that, because it's not in line with what you are doing.
Okay, thanks.
Yes, because butchery, I'm looking at those the expenditure, like, the ingredients, the spices, the meat, because those are in line with what you are trading. Is a butchery, and I cannot expect to see bread and clothes in a butchery business. I cannot expect to see that. Then those expenses, I will disallow it, because it does not fall under the nature of that business.
Okay, thanks.
All right. So, Serge, I'm going to emphasize what you have said before we leave the session, to say If you are not on WhatsApp, please let Search know so that he can put that on your WhatsApp group, because there are something that are going on within the WhatsApp group. You need to know what's going on, because that will be our line of communication. And the second part is those who missed the first quiz for tax, please again send email to me or Miss Katuta's name, so that we can be able to open that quiz for you guys, those who registered late for this course. The last announcement was we will continue to have our session from 6 until 8:30, because the majority of the students, they say they are comfortable in having this class at night as compared to in the mornings. Those are my announcement, guys. Let's continue. We are left with only about 6
Can I
slides or
quickly
7.
can I just ask a technical question? And I'm not sure whether you'll be able to answer or search. If I go
Let's hear
on
that.
to,
It's Leonard.
if I go, it's Varun.
Oh, go ahead, my brother. Go ahead.
If I go on to Moodle, then I'm not able to open the practice and revision questions on trading loss. It seems like the link isn't working. I can open and download all the others, but the questions for trading loss, the practice and revision questions, the link doesn't seem to work on my side.
Oh, wow. How come? Let's hear from others. Maybe there's something, then I need to go and revisit, because I can be able to open. Let's just hear from others if they are able to access those practice and revision questions.
I can access all the others, the
Yes,
trading
and
deductions,
yeah.
the questions and solutions, but it's only the one link for the trading loss, the practice and revision question that's not working.
I hear you, Veron. Let me just hear from others so that I can go and, if you encounter the same issues, maybe they say it's wrong, there's something wrong with the link, I can go and revisit and check. So let me just hear from others, guys. Do you explain the same problem, guys, to access the practice and revision question for trading and assess losses? Guys, you cannot be neutral, whether you can assess or not. Kando, can you access
Yes,
that?
my
Can you
fellow.
access? Yeah,
On my side, actually, I can access, and I've
you
managed to
can.
download all of them. Yeah.
Okay. What are the
I
others?
also did access last week, but
And can you access those practice question and revisions?
yes, I did last week.
Okay. So Veron, I don't know, how can I assist you with that? I don't know if the others can access and you can't access. Search, what is your take on that? Because I don't know what to do if others, if maybe everyone cannot have access, then I would say there's something wrong with that link.
Yeah, you
Can I
should
maybe
try again at
There are two.
Sorry?
There are
You
two
can try.
files in there. The other one has a hyperlink, meaning that there's information attached to it. The other one is just a wording that sort nothing. You must use the last one at the bottom, the last one that has a hyperlink in it. It's gonna give him the information.
Yeah, but the last one is the solutions.
It's a practice and
Can I,
solution. Let's say it's a practice and solutions.
I put the practical in the solution, practical revision
Practice
questions and
and revision
solutions.
questions. Yes, that one is working. I've
yeah,
just downloaded it now for
yeah.
the trading loss. Don't use the
But
first one. The first one doesn't have anything attached to it. The second one is the one that has information.
Okay, I will check on it. The one that does not have anything, I'll delete and leave the other with information. I'll check.
Can I maybe just quickly share my screen and explain to you what I mean?
All right.
Veron, if maybe we can, okay. No, let me just allow that, because I was saying, let me just finish this and we can attend to you. Is it okay with you, Veron?
Yeah, either way, it's fine.
Yes, because and Search is recording. Let's just finish this. Then after this, he will stop recording. Then you will show us your screen. Is that okay with you, Veron?
100%.
Oh, thanks, my brother. Let's continue. Then we are on additional requirements for an assessed loss to be offset against income. There are some additional requirements of which we didn't deal with. That's why we are dealing with those two additional requirements. One of which, there must be a trade. I talk about genuine trade. There must be a trade, and there must be income from that trade. That's the requirements. In terms of companies, you must have a trade. Income must come from that trade. Then if, again, there is any assessed loss, then it will be offset against the income from that trade. So in the absence of the above, and it is straightforward, if you're not trading, either way, you are going to lose or forfeit that assessed loss. Because for you to claim assessed loss, there must be continuity in trading so that you can be able to claim or deduct that assessed loss against that income. That is very, very important. And there is some exclusions in terms of individuals and trust, because they say they can still claim for that loss. Let's say this year there's a loss for individuals. Next year there's nothing for that. No trade, there's nothing. Come the other year, then the act allows individual and trust to claim or offset that assessed loss that was incurred previously. But in terms of companies, you cannot stop this year. You are not trading and you want to claim assessed losses. No, there must be continuity. But in terms of individual and trust, it doesn't matter. As long come next year you start to trade, then you'll be able to offset that loss from the previous years while you were not trading. And again, trade requirements. Companies' activities need to be scrutinized. Why companies' activities need to be scrutinized? Because it must be a loss from the same trade. It must be a genuine trade, so that SARS can allow that particular company to claim assessed losses. That's why those activities need to be claimed, to be scrutinized, because SARS wants to find out if expenditures that are claimed by that company are fall within the definition of Section 11A, General Deduction Formula. Are those expenditure valid? Do they meet the requirements of Section 11A? If they does meet the requirements, then you can be able to offset any assessed losses that comes from that trading for that particular year of assessment. That's why it says the activities must be scrutinized. If you are running a bakery business, then I need to see expenditures that are relating to that butchery business or bakery businesses. So you cannot take your personal expenditure and brought into companies' activities and you want to claim those. No, you can't. And again, you cannot claim something that is of a capital nature. That's why the company's activities need to be scrutinized to make sure that the company claim the valid expenditure in terms of the required sections of the Income Tax Act. Then it continues to say whether carried on any trade. In that specific year, income for a specific year is on interest, whereas it is a manufacturing company. Where's that? I lost my slide. Oh, all right. Now, this is my slide. Then, in fact, to summarize this slide, there must be a trade and there must be income coming from that trade. And there must be a continuity, meaning that you need to be trading for you to enjoy the benefit of deducting that assessed losses. Requirements. It says where an income from a specific case only interest, whereas it is a company, manufacturing company. Look at this. If it's an interest, then there must be a problem. Unless if this company borrowed finance to run its business, or unless this company invest and receive interest income, but it is involved in a manufacturing company of which we need to see trading going on. Because when you receive interest, you are not trading. That's not a trade. Then it can be established that it did not carry on a trade. Because interest, you are not working for that interest. You just invest, you just sit down, you receive return on that investment. Therefore, you are not trading. And if you are not trading, then you cannot have the right to deduct any assessed loss. You cannot have the right to offset assessed losses against any income that has been derived by that company. Company has to prove that trade was carried on. Prove that trade was carried on. There will be some the stock within the company. There will be a lot of things that prove that yes, the trade was carried on. Then if you can prove that, then yes, you can be able to deduct that or offset. Not to deduct, but to offset. Offset and deduct is almost the same thing. But in text language, we offset assessed loss, but we deduct expenditure from income. Trade need to have resulted income in that specific year of assessment. And again, the loss must be incidental or must be as a result of the nature of the trade. Because that particular income must come from that trade. If you are a manufacturing company, if you are a construction company, the income must come from that manufacturing company or a mining company. Look at this. They say, because these tax authorities, SARS will assess whether there are reasonable prospects of profitability. They use what we call objective test. Then what is an objective test? Why SARS is relying on this test? Because in tax law, when determining whether an expense is wholly or exclusively for business purposes, an objective test tasks whether a reasonable person will consider the expense necessary for running the business. Let's see, for example, if a business buys an expensive sport car and claim it as a business expense, the test will evaluate if it is genuinely for business use or a personal luxury. Because unless you are in a trading of selling expensive sports car, but if not, then SARS will use that test to determine whether that particular expenditure is genuine. If it is not genuine, you cannot be able to claim that particular expenditure. Are we together, guys? It must be a genuine. Genuine means it must link to the operating activities of that particular company. The limitation of the balance of assessed losses. We have said earlier to say, yes, there's a limit. Because if there's no limit, it means most of the companies will result in getting refunds from SARS. But by the introduction of Section 20 Cap A, ring-fencing, companies are not receiving any refunds from SARS. That loss will be limited against that taxable income. Then the difference will be carried forward. Unless if, let's say, but that will not be an assessed loss if the income exceed the assessed loss. It won't be as there will be a tax to be paid. But when the losses exceed the income, that's why they say that loss can be limited to that particular income, then it meaning that the result will be nil. There's nothing to be taxed. However, the balance of that loss can be brought forward and be used against other years. Talking about the 80% of taxable income, of which you will see in the next slide, it talks about how to utilize that 80% on your taxable income. And the threshold of R1,000,000, it says, whereby the balance of assessed losses is greater than 80% of taxable income of the current year. The limit is the higher of 80% of taxable income or 1 million. It will make sense, or it will be understandable when we look at this particular example. We are still on Mr. Malakela. Let me see if I can see this. Oh, it's Mr. Malakela, of which left his job to focus on his practice. This move allowed him to take labor matters. He also decided, remember the previous example, the company did not allow him to take these labor matters, but on this one, he fully committed to his practice. He also decided to incorporate his service and trade as Malakela Incorporation. His company made a loss of 1,300,000 in its first year of assessment. On the last day of his company's year of assessment, he had an opportunity to study full-time and specialize in medical negligence. This intensive program takes 12 months to complete at Harvard. In the 3 years, he resumed his practice and made a taxable profit of 1.2 million. He approached you for an advice. Do you still remember the steps? 3 out of 5 periods, of which in 5 years, that 3 years, the company must be profitable. This is what it talks about. Then Mr. Malakela, he asks you for an advice to say, here's what I've done, what has been transpired within my incorporation, my business. I need an advice how to go about claiming assessed loss on my income, because there's a profit of 1.2 million. And again, there was a loss that was experienced by this company of 1,300,000. Look at this slide. Advising Mr. Mali to say his assessed loss in the first year of assessment is 1.3 million, of which it was given. And Section 20 allows him to carry this assessed loss forward. How to do that? Mr. Malakela will only claim this assessed loss only if there is a continuity in his trade. If he can stop trading, then he will lose that assessed loss, because the requirement of Section 20 subsection 1 is not met. It's what it says. As he did not trade in the second year, the assessed loss of 1.3 million is forfeited, because the Section 20 subsection 1 trade and income requirements were not met, because they say in that 3 years he was not trading, because he was in Harvard for medical, let me just see what it says exactly, but he was not trading at that time, because he had an opportunity to study full-time and specialize in medical negligence. This intensive program takes 12 months to complete. It means that year he was not trading at all. Look at this. His company will be taxed on 1.2 million generated in the 3rd year, because in that 3rd year, when he came back, he continued and he made a profit of 1.2 million. However, he forfeited that loss because there was a break even. There was stops where he did not trade. There was a year that he did not trade. Then they say, because we are advising to say, had you hired a manager so that that trading continue, when he left, he was supposed to hire someone to make sure that that trading continues. And if that's the case, he will not lose that 1.3 million, because there was a continuity in trading. Then if that's the case, then that 1.3 million will be set off against that taxable income if he was trading all along. Then, because they've talked about the rules, 80%, because it must be 80% of your taxable income or the lower of 1 million threshold. That's the limit. Look at this, because he made a 1.2 million profit and 80% of it is 960,000, which is lower than 1 million. Then it will be therefore being limited to 1 million, because it says it limited to 1 million. Why? The income was 960, but it must be limited to R1,000,000. And if that's the case, it means the taxable income of 200, because it will be 1.2 million minus 1 million, the limit, then it will result in a taxable income of 200,000. And the same applies to the balance of assessed losses, because it will be 1.3 million if there was a continuity in trading minus the limit of R1,000,000, then it will arrive at 300,000. That will be taken forward to next year. For example, let's say he was trading and he made 1.2 million income. Then they say 80% of it is 960, of which we are happy about that, because that's the law we need to apply. Then the limit, they say he can only enjoy the limit up to R1,000,000, which means there will be a difference of 200,000, because the total profit was 1.2 minus R1,000,000 limit, then there'll be 200,000. And the balance of 300, it comes from a loss of 1.3 million minus the limit of R1,000,000, then 300,000 will be carried forward for next year. If he continued running a business trading, that loss he will enjoy come next year. Then Section 20A was introduced. It says anti-avoidance measure, and it was introduced for the purpose to reinforce losses. If the requirements are met, then that losses can be ring-fenced, can be offset against any taxable income, but it must be from a trade. And they are continuing to say to who it applies, is it applies even to individuals. Effectively limits the deductible expenditure incurred in conducting a trade. That's why we said it must be limited to your taxable income, because if it is not limited, then you'll get a refund, and it's not what SARS wants. SARS wants for continuity, because you'll get a refund and you'll stop trading. The excess spending is rolled forward. Yes, it will be carried forward for next year, and it will be set off against any income that will be generated. Then, then you'll pay tax on that income if there is an income. Then it talks about the 4 steps that simplifies and determine whether a loss should be reinvested. The first step is the maximum marginal rate of tax requirement. What is that? It aims to determine whether the taxable income of the individual taxpayer before setting off any assessed loss from other trades. And again, step 2, 3 out of 5 are listed suspect trade requirements. We spoke about this. They say in 5-year period, within that 5-year period, you must be making a profit. Just 3 years in that 5 years, you must be making a profit. The business must be profitable. They said the above step 2 has got 2 parts. 3 out of 5 years, we spoke about it. And they explain it to say this requirement looks at taxable income for 5 years, which includes the current year of assessment. Because if your year of assessment is February, then it means 2025, because we are ending now the month of February, then it will be 2020 until 2025. That is a 5-year period. And in that 5-year period, you must be generating profit in 3 years out of that 5 period. It's what it says. And it applies to trades that are not specified as listed suspect trade. The suspect trade, these are this kind of trades that are talking about. They say listed suspect trades. And assess loss from any of these 9 trades triggers potential ring-fencing immediately. If the loss is from these trades, 9 trades, automatically it triggers ring-fencing. Then that loss can be offset against any taxable income. And they listed them, this kind of listed suspect trades. That it means these are genuine trades. SARS has conducted an objective test on this, and they are satisfied. That's why they can allow the taxpayer to be able to ring-fence any assessed loss that has been incurred by this particular company. Let's see an example of that suspect trade. Florence has completed the ACCA exams. She's now a member. Now that one of her goals has been achieved, she decided to spend more time on her childhood passion, of which is cooking and baking. She started a catering business as a sole proprietor. She uses his business as a stepping stone to get her TV show on cooking, and ultimately to own an upmarket fine dining restaurant. She has a detailed business plan, and 2 FMCG companies sponsor some of the ingredients she uses. She travels a lot and promotes her business at ACCA and the CFO South African events. As a result, she has been running at a loss for the past 4 years and has had to inject cash into her business because she is still in a full-time job. For 4 years, a taxable income from her job has been above the maximum marginal tax rate. She does not remember the requirements because she has been focused on her business. Then, because Florence asked you to give her an advice, then you look at those steps that we've mentioned before in the previous slides to identify whether the taxable income has been above the marginal tax rate, of which, yes, it is stated in the example that is this above the marginal tax rate. Then we've satisfied ourselves with first step. Then we look at this now, a passion of cooking, catering. And this is not on the listed suspect trade. What does it mean if it is not? But she has made losses in the first 3 years of her business. As a result, losses from catering business could be ring-fenced subject to other steps. Then they say there must be trading, income must come from that trading. And if she can satisfy those other steps, then she could be able to claim or to offset that losses. Only if those steps are met. If one of those steps is not met, then Florence cannot be able to enjoy the benefit of that losses. There's nothing to be ring-fenced against her taxable income. Then, because the losses suffered in the first 2 years may be used to offset income from a job. From the third year, losses from a catering business may be ring-fenced. In fact, if you can put this down, you look at the example, you look at the solution, and look at those steps, you can be able to advise Florence, because you look at the step. If that is met, yes, she can go ahead and offset that losses. You look at the second step. If she does meet those steps, if all the steps are met, yes, she can be able to go on to offset that ring fence. But here it explains that in first 2 years, yes, she can be able. From the third year, losses from a catering business may be ring-fenced. So it means you have to look at the example in totality with the solution to see if it does make sense, to see if you can be able to advise Florence in this manner, or you have some comments, but those comments must be come from the steps. Because for you to advise Florence, you need to look at the steps. That will be your guidelines before you can advise Florence. Then, if everything is being met by those companies, then you can be able to advise her. And when I look at this solution, it does link with those steps. So this one, guys, please just have a look at it more again and to see if it does make sense. If you were in, or you are an accountant or a tax consultant, is it the way that you can advise Florence? If it's not, then you need to go back and revise and check those steps, because this solution, it comes from those steps. That's why this person who advises Florence, she looked whether those steps are met, whether those requirements are met. So if they are met, yes, you can be able to do that. If they are not met, no, you cannot. Yes. The anti-avoidance measure ring-fence losses. The facts and the circumstances test. That's why when you look at the courts, our courts, maybe everywhere in the world, they look at the facts or the merit of that particular case. And there is a test to be applied, whether it does meet the requirements stipulated in that particular section of the Act, for them to be able to derive at a conclusive decision. The tests are: ring-fencing provision shall not apply to a trade with reasonable prospect of deriving taxable income other than taxable capital gains within a reasonable period. That's why they said before that it must be in the same year. Is those losses incurred in the same year? So we need to identify. There must be facts to determine whether the particular losses can be ring-fenced. And again, fact number 2, the above step is regarded as an escape clause, because even if a trade met one of the requirements of step 2, for as long it has reasonable prospect of deriving taxable income in a reasonable period, it will not be subject to a ring fencing. That's why it says once you missed one step, then whatever you do, whether you derive any profit or taxable income, if one of the facts or the test or the step is not met, then you cannot be able to offset that particular assessed loss against the taxable income. Let's see. These are the commentary for step 3. Just to put this step into context for us to understand these particular steps. They say this step requires Florence business plan and its implementation so far as to be interrogated objectively. Remember what we have said for the commencement of business. You need to have a business plan. And again, SARS cannot assume that because the two FMCG companies are sponsoring here, then her business plan is viable. Look at this. SARS looks at a lot of things, guys. It looks at a lot of things before they can allow you to claim that particular losses. The objective testing of a business may question whether traveling and promotion may produce the desired results within a reasonable time. Is that travel or promotion, are those expenses incurred to derive income? That's the test that SARS want to go through. It's not for personal purposes, not for holidays. They need to have those facts. They need to satisfy themselves as the tax authorities that yes, indeed, the traveling expenditure that incurred by Florence are for the production of income. The last one, it says, if Florence catering business does not pass this test, the loss will be reinforced and not be offset against any income from a salary. For a salary, she will continue to pay tax on a marginal tax rate where she belongs based on a salary, then it will be taxed according to individual tax table. The last steps is the 6 out of 10 years rule. What does it say? It says this is known as a catch-up all or the end of the clause because we have the rules until the 10 years rule. That is the end of the rules. It's from 1 until 10 years. Then it says it can nullify step 2 as it stipulates that the step 3 is not available to a listed suspect trade. That's why I said the reason why they gave us those suspect trades is for us to determine whether assessed loss can be offset. If one of the trade is in that list, then it can be able to be offset. And the 10-year rule, it says in that 10 years period, the 6 years, the business must be profitable. Step does not apply to trades that are not on listed suspect trade. That's why I said you need to look. That's the purpose, the reason why they've listed those suspect trades. For us to be able, or for the tax revenue to be able to allow the offset of assessed loss against any taxable income, because they will check, is it one of the trade that is within the suspected trade? That's why they mention them. They say there are none of them. Then when the trade meet this requirement, then you can apply ring fencing. That's why I said you need to meet the requirements, the criteria that are being stipulated out of these steps. If those steps are met, then you can be able to offset assessed loss against any income that will be derived by that particular business. Guys, we are at the end of our session tonight. And if there's any questions, then I'll open for questions. And bear in mind that Veron has got something to show us. Then let's hear from you guys. Any questions, or you're still going to have a look at them, familiarize yourself with questions. And if you have questions, please forward them to us via email. Any questions, guys, before I give Vernon a platform to share his screen?
Can I maybe ask a question on the slides first?
Yes, please do that, Vernon. Yes, it's what I've requested first.
If you go to the listed suspect trade slide,
Yeah.
and I just want to make sure,
Yes.
does this mean that the trades listed under this specific topic
Yeah.
that that assess losses from these trades can only be offset against income from these trades? Or is it the other way around?
Absolutely, 100% correct. And
Okay.
again, others will agree with me. That's why the reason why they listed this suspect trade, it means any assessed loss from this can be offset against the income from this trade, suspect trades. You are 100% Vernon.
Okay. And then maybe just a follow-up question. Could
Go
you
ahead, sir.
just go to the last example? Where the lady made a loss for 4 years.
Florence. Yes,
Yeah.
yes. Let's look at the example first before we go. Yes. Let's look at this.
Yeah.
Maybe your question will be derived from this. Okay, but yeah.
Okay. So my question is relating to the
Where's my
three out
sliding?
of the
Oh, yes,
three out
yes.
of five years rule. Right?
Yes. Mm.
And if you maybe can just maybe explain that again, because yes, he made a loss 4 years
Yeah.
in a row.
Yeah.
But she's allowed to set off in the solution. It indicated that she's allowed to set off. I think it indicated
Yeah,
something like
yeah, no, you are right. Let's go one by one. Let's read this and go to our solution just to link the two and the commentary. Because they say if you are on that list of suspected trade, then you can be able. It means whether in 3 years or 4 years you're making loss and everything, as long as that trade is part of the suspect trade, then you can be able to claim that you can be able to offset that assessed losses. Only if it is part of suspect trades. Let's look at it again. Veron. It says Florence has completed his years. Now that one of her goals has been achieved, she decided to spend more time on her childhood passion of cooking and what and not, and baking. Then she started a catering business as a sole proprietor, because a catering business, it involves this cooking and baking, isn't it? She uses his business or her business as a stepping stone to get a TV show on cooking and ultimately to own an upmarket fine dining restaurant, of which is part of a passion. She has a detailed business plan, and two companies sponsor some of the ingredients she uses. She travels a lot and promotes a business. Look at this. Once they say she travels a lot and promotes a business, so it means whatever expenses that is incurred, it must be deducted. And that expenditure, it can form part of the expense that exceed her income, of which it will result at a loss. Then, as a result, she has been running at a loss for the past 4 years and has had to inject cash into her business because she's is still in a full-time job. For 4 years, a taxable income for a job has been above the maximum marginal tax rate. Remember, there was a loss, and again, they say there was a taxable income for 4 years for for a job has been above the maximal marginal tax rate. She does not remember the requirements because she has been focusing on a business. So what they're saying, she wants to offset assessed losses from that period, the first 4 years, with the income that she experienced now. Then she wants to know if it is okay for her to claim that assessed losses. They say loss-making side has other trades. Then look what they're saying here. Then first of all, Florence taxable income has been above the margin. It's what they've told us, isn't it? We agree. That is first step. When you look at the previous slide steps, losses could be ring-fenced depending on other steps. So meaning that you have to look at those steps in totality. It's not focus on one or two. For example, if one step has been missed, then she can not be able to ring-fence that loss. Then number two, because her passion is only catering, cooking, or baking, and this is not on the listed suspect trades, but she has made losses in the first 3 years on a business. As a result, losses from a catering business could be ring-fenced subject to other steps. Even though this is not on the list, but because the losses from a catering business is the same trade, that loss comes from the same trade. That's why they say it could be ring-fenced, because one of the requirements is the losses must be from the same trade. For you to claim against the taxable income, they must be from the same trade. So here they are saying, remember, it's an advice to say, yes, you can only claim assessed loss from a catering business as long as it is from the same trade, because one of the steps is there must be a trade. The income or the loss must be from that trade, because this is the same catering business, cooking is the same trade. So because it's the same, then she could be able to claim those losses. And they're saying in 2 years, the loss suffered in the first 2 years may be offset to income from a job. Remember what they've said against individuals. Individuals, it's not like companies. Companies, there must be continuity. In terms of individual and trust, it doesn't matter. You can still claim that ring fence. And for you to claim the ring fence, it meaning that the losses or the expenses must be linked to the trading activities of that company. Meaning that whatever you deduct as an expense must be relating to Section 11A. Then, because that loss must come from the expenses incurred from Section 11A, because they need to be deducted against the income. If the expenses exceed that income, then that loss will arise. Then that loss, because it's on the same trade and those expenditures meet the requirement of Section 11A, then that loss could be ring-fenced come next year against any taxable income that will be derived by that company next years to come. I don't know if I've explained it thoroughly, or maybe you need just to have a look, the slide, the example. It is there in your textbook. I'm glad most of you got the textbook. Just sit down and have a look whether it does make sense. You do understand the logic behind this.
Yes, it's just slightly confusing that in bullet 2 it says the first 3 years of the business.
Yeah.
As a result, losses from a catering business could be ring-fenced, subject to other steps. And then in the last bullet, it kind of contradicts where it says then the first 2 years might be offset against her income. Isn't that a little bit contradictory, the two?
No, it's not. Remember,
because here it only says from the third year, losses from catering business may be ring-fenced. Here it says The first 3 years of the business,
Mm.
maybe ring fence.
Remaining fence. So that's why I say it is confusing as it looks like. But when you look at the steps, when you apply the steps, it's like it's contradiction. It's not a contradiction because it talks about the steps. Because one step says so, the other steps, remember, those steps are different. But at the end, you need to meet the requirements of those steps. Because you will find that in some area, one step is missing, then you cannot. But in the other areas, you can, those steps are met. Then if they are met, then you are free to offset any assessed losses against income. So what needs to be done here is to look at the steps, and you take this solution and compare with the steps whether each line does meet the steps.
Okay.
Just
So
have a look
just
at
for,
it, and if you're still confused, then drop me an email. Because
okay.
I'm thinking if you can have those steps down and you link the solution with the steps to answer your question, then maybe you will have an understanding what's happening through this solution.
Okay, and just out of interest, do you see ring fencing as a positive or a negative for the taxpayer?
It is positive because it is positive in this way because it reduces your taxable income, isn't it? For in case for you to pay tax on 27,000 taxable income, you can end up paying less tax because of that assessed losses, isn't it? Does it make sense on that one? So
Yes.
then that is the positive part of it. The negative will be if you don't continue trading, then you are going to lose that assessed losses. That will be the negative impact on your financial statement, on how to be taxed. Because negatively, it means you are not going to enjoy the benefit of assessed loss and will be taxed on a higher taxable income. You get that, Vernon?
Yes. No,
Assessed
100%.
loss, yes, because assessed loss, if there's no assessed loss, if your taxable income is 1.2 million, it will be 27% on 1.2 million. But if there is a portion of assessed losses, then it will reduce that 1.2 million, maybe to a million rand. Then it will be taxed on 1 million instead of 1.2 million. Did you see that? Do you see that logic?
No, yes, I get that.
All right. So anyone, guys, before when we can share a screen because we want to see what's wrong with the link. Anything from you guys before I give Vernon a chance?